Welcome, everyone. So we're here to talk about alternative finance. So what is alternative finance? Well, we're not traditional banks. So what are we? Well, I'm going to let my distinguished panelists explain what they are, but you probably already know that. So to my left, Tim Johnson from Blackstone, and to his left, Andrea BALKAN from Brookfield, and Sang Yu from Apollo, and Jeff FASTOV from Square Mile. All top in their fields, all doing incredible things on the debt side. Silverstein has its own little debt platform, but it pales in comparison to each one of these fine people. So I'm going to let them take it away and let them describe what they do, and then we'll ask them all a bunch of questions. So go ahead, Tim.
Sure. Thank you so much for having us here today. I'm Tim Johnson. I oversee our real estate debt business at Blackstone. Really, we organize ourselves in this alternative space around kind of three main strategies. The first one is high-yield fund investment, which we're investing out of an $8 billion fund right now. We also have a public mortgage REIT, Blackstone Mortgage Trust, where we make first mortgage loans that are a little transitional, not as deeply transitional as what we do in the high-yield space. And that's about a $22 billion loan portfolio. And then we have a growing insurance platform where we're lending longer duration across some more stabilized assets and a little bit more granular than what we usually do, which is kind of bigger assets in the big global cities around the world. And we're mainly focused on the US, Europe, Canada, and Australia.
Thanks. Andrea?
Hi, I'm Andrea BALKAN, and I oversee the real estate lending businesses at Brookfield. And so, like most of my colleagues, we have several different platforms we're investing for. So we have a mezzanine debt fund, which is $4 billion, which is really looking for 60 to 80% loan-to-value slice of the capital stack. We have an open-ended debt fund, which is looking for slightly less leverage, but still focused on mezzanine debt. We've got some separate accounts, and then we've recently brought in a whole bunch of insurance company capital that will be lending in more the first mortgage space with some more senior level mezzanine debt.
Sang?
Thank you, Marty. Sang Yu, I'm a partner at Apollo. I'm part of the commercial real estate debt platform. We manage about $36 billion of AUM across Europe and the US. It's mostly for our affiliated insurance companies, plus mortgage REIT and other separate managed accounts. And we, like my colleagues up here, we do all types of financings, everything from stabilized, cash-flowing properties to pre-development loans, construction loans, and bridge loans.
Jeff?
Thanks, Marty. Our goal at Square Mile, my personal goal, is to be just like Tim someday. I don't know if it's attainable. You should have realistic goals. Seriously, we are a non-bank lender. That means we do things that banks don't want to do or can't do. So we do levered construction credit and value-add credit and stabilized lending on a leverage basis, just like my colleagues here.
So Jeff, how much of your portfolio would you say is construction lending versus non-construction lending?
About a third of the total commitments. Construction lending start kind of dry and then they get funded over time. But if you look at commitments, about a third of the total. So very significant. We like construction lending because it's a little less crowded, but it also, we think, gives us a chance to integrate with our equity development business and provides a little bit of an edge in terms of deal selection, underwriting, relationships, et cetera.
And when you do construction lending, do you usually play in the whole loan? Do you do the senior or the mezz?
So it's a combination. I think warehouse financing, which is prevalent in value-add lending or CLOs or whatever, is a little less prevalent in construction lending. So we work to put a deal together, but then you typically place a senior with a bank or get note-on-note financing from a bank, which is like a mini warehouse just for a deal or two.
And Sang, we were talking off stage before, and you told me the volume you're going to end up doing this year, and it blew me away.
Yeah.
Why don't you tell the audience,
and
tell us a little bit about the makeup of that.
Sure. In 2021, we should be on track to do close to about 15 billion of new originations. And it's a pretty broad mix of products. I'd say we've had a pretty good year in Europe this year, so we pretty much 50-50 between the US and Europe. And it's several billion of senior fixed rate loans for our insurance companies, a lot of floating rate bridge debt, and throw in there some pre-development loans and some construction debt as well.
15 billion with a B. Wow. Andrea, what's the makeup of your portfolio?
So interestingly, right now I would say construction lending is a higher percentage of our portfolio than it probably has ever been. You know, we typically like to keep construction loans to less than 20% of our portfolio, but coming out of COVID, what we've seen is we've done a lot of multifamily and industrial loans, but they're relatively small sizes. And on the office side, there aren't that many acquisitions going on, so we're not seeing as many existing office buildings. What we are seeing are some really interesting ground-up construction in the office space that we have been pursuing. And it's nice because it also fits, all of our ESG requirements because they're new and kind of state-of-the-art. So, not much on the retail side, not much on the hotel side. We'd like to do a lot more in office, and I suspect in 2022 we will do more in office as more properties trade. But right now it's, construction on office and, more value add on multifamily and industrial.
Great. And Tim, I guess Jeff said he wanted to emulate you because you had the biggest number of the group. Why don't you tell us what's happening at Blackstone on the debt side?
Sure. So in terms of 2021, through the end of the third quarter, we had done about $16 billion of loan volume, which I think should eclipse $20 billion by the end of the year. And that's across all the strategies that we talked about before and across the globe. And it probably breaks down to about 2/3 in the US and about 1/3 outside the US, which is predominantly Europe and a little bit in Australia. And I wish I could say we were more creative sounding relative to what everybody else is doing up here, but I think thematically we're all kind of looking at the same types of things and working on the same types of things. So construction lending is maybe 15 or 20% of what we do, but it's still, in terms of dollars, a pretty big number. And I think Andrea hit on a couple of the points on the office side, why it's been a good asset class to lend on. And I think coming out of COVID, and managing through COVID, it was not something we were really very worried about in terms of the performance of our portfolio, which in other prior, especially real estate-driven cycles, you'd be worried about your construction lending portfolio, and we kind of felt the opposite, where I think the trend of high-quality assets that are new build being more in demand is going to continue to be even stronger than it was pre-COVID. So I think that's kind of one of the things that's driving our interest in that space in particular, and then we have been expanding. We have done more outside of the just office, multifamily, and industrial. We've done a good amount of hotel and some retail lending here and there. So I think we'd like to expand that for sure in 2022.
Great. So that's a good introduction to these folks. I'm not going to go up and down the line 16 times asking the same question, so I'd like to have more of an interactive conversation. Both Andrea and Tim sort of touched on COVID, but I'd like to hear how COVID has changed your underwriting, maybe the asset classes you're going after now. Tim, you already delved into it, so have at it, guys. How has COVID changed your underwriting, the assets you're working on?
I mean, look, from an underwriting standpoint, I think, we've always looked at it on a deal-by-deal basis, the real estate, the sponsorship, business plan, et cetera. In terms of, asset types that we focused on now, I think, we took a brief pause with the onset of the pandemic. I think we resumed hospitality lending pretty quickly. We found some good opportunities to do low leverage hospitality acquisition loans where we, got pretty good pricing and good structure. We've actually done a fair amount of multi and industrial, although it's been super competitive, but mostly for the fixed rate side for our insurance capital. And that's been a good source of business for us. And then, on the office side, we've been, we've done, a little bit of CBD office. Typically, we don't do a ton of suburban office, but we've also found some good credits there. A lot of long-term net leases to credit tenants that we've done for our fixed rate business. And then, selectively, we've done some, life science conversions and other conversion and construction deals.
Yeah, I think one of the things, we do a lot is we learn a lot of lessons from our equity side, and we tend to follow them a little bit. And one of the things we're seeing on the office side is tenants are all looking to move, to the best, the nicest, the most ESG-friendly buildings. And so, we've always liked Class A buildings better, but we're really staying away from the B minus type of buildings because we see the tenants staying away from those buildings. And so we're really focusing much more of our lending on, the A-type office buildings.
Great. One example of that, maybe an extreme example, is we bought the risk retention bond on One Vanderbilt, which you could argue is as good as it gets, but also comes with a value per foot as good as it gets too. But we felt, put it all together, we'll take that bet.
Well, I guess it depends when you bought it or after the lease up. None of you really mentioned retail. Anyone touching retail?
We've done a little bit, and I think to just expand on what we were talking about with COVID and how that's impacted your underwriting, what you're thinking about, and I think this is kind of real estate wide. When you look at what it's done, I think it's just accelerated a lot of the trends that were favorable pre-COVID, and then also there's been a lot of acceleration or deceleration in the trends, and sort of the negative on certain asset classes like urban hotels, for example, which were challenged before COVID and now continue to be challenged, and enclosed malls. But outside of the generic enclosed malls, I think we do see a lot of opportunity in the retail space. What we've been focused on, kind of dipping our toes into it, is more smaller strip center retail that's convenience-based and within a short drive of a good population base, or some specific power centers that have, again, good demand built in around them. So I don't think it's an asset class that is necessarily can be totally written off or should be totally written off, but you have to be relatively specific in what things you look at. And you're seeing today in terms of retail sales that there's definitely a rebound going on, with the consumer getting back into, to a certain extent, some bricks and mortar retail.
So Andrew, you touched on it. You said you learned a lot from your equity side. All four of you have incredibly successful equity shops, and the debt side sort of grew out of that. Is there a Chinese wall between your debt and equity shop, or do you all sort of feed off of your equity shop for information? I know we do. We call it our secret sauce. But I don't know if you're supposed to set up, these Chinese walls.
Yeah, we're the same way. We don't have a wall between our debt shop and our equity shop. And in fact, our equity business invests in our debt funds. So things are very much, intertwined. I mean, almost every time we see a request for a loan, if someone on my team doesn't know the market well, we're going to call the guys in the equity shop and say, what do you think about the market? The information tends to be a little more of a one-way flow, where the equity guys, give us information on the markets rather than us, necessarily giving them information. But we do give them advice when they're looking to finance things, and it sometimes falls into, hey, is this a good lender? Should I deal with them? Is this going to be, these terms seem too good to be true. Are they going to, retrade me? What's their reputation? So theirs is more quantitative to us. Ours is more qualitative to them. But.
Yeah. I think you hit it on the head. The information sharing we definitely view that as our special sauce as well. Our investors, one of the reasons they supported our business when we started it was because of that information flow, and that, I remember I worked at a bank before, and when you were doing your diligence around, an asset or a market, you would call kind of third parties in the market that you had built relationships with, and you hoped they would give you good information, but they weren't necessarily incentivized to always give you good information or always be responsive. And our colleagues on the equity side of the business are incentivized in the right ways, and we get real-time data that's really, really helpful, especially when you're looking at a market like we've been in recently, where you're seeing very, very dynamic moves on the multifamily side in terms of releasing spreads, or very dynamic moves on the industrial side. And having that feedback and that information is hugely valuable to being able to make good credit decisions.
Sounds like we all have special sauce. Maybe it's just duck sauce. We all have the same sauce here. We have a protocol where the equity guys in our regions actually present with the debt people at investment committee. So we take that integration and no separation really seriously. And I was just thinking about, on the prior panel, one of the comments that were made is this wall of capital is one of the things that made the downturn or the impact of COVID a little less muted or more muted. I also think it's the connection between debt and equity, which is helping too. Like, I'm thinking about the issues we've had in our portfolio And the ability to think like an owner got us to a resolution a lot faster. So when we think about like whether it's the impact on hotels that were shut down or even some retail that we have, the conversations were very commercial and very pointed and efficient, which is, this is how we view the situation. If you don't want to put capital in, let's just work on, we'll take it over. So there wasn't a standoff where kind of real estate rots for a while, like in the old paradigm where a lender really doesn't want to deal with the real estate. So maybe it's better because of not only the quantity of capital, but the connection to equity.
So when we go out to make a construction loan, we make it very apparent to our lenders, to our borrowers, that we're not loan to own. None of you guys are loan to own. So how has delinquency factored into your portfolios of the last couple of years?
We really haven't had any delinquency across the portfolio, and I think a big trend coming into COVID for lenders was that leverage was not particularly high as it has been in other, again, like real estate driven cycles. So if you were mostly oriented around new acquisition financing pre-COVID and you were in good asset classes, you rarely saw a situation where institutional equity owners were kind of getting weak in the knees. I mean, they really stuck with their assets. Maybe there's a little bit to be said about the fact that we're not all loan to own in any way, shape, or form, but we can own real estate pretty easily. And I think that probably has a little bit to do with behavior at the end of the day. It's not as easy as it is with maybe other institutions who aren't so equipped to own the real estate if they had to. But I think that it was definitely our experience, I think a market-wide experience, that there was pretty broad-based support for assets from the borrower community, especially large institutional borrowers.
Yeah, I would echo that and say, we've got two pieces of REO that basically we took back several years ago out of our 2014 fund. No delinquencies in our 2017 fund, so no real COVID-related problems. And in the two cases when we took back assets, really good assets, in both cases you had really strong sponsorship, but you had too many of them. So you had a case or the building where you had 3 groups in there, and it could be 2 institutions and 1 family, and they just didn't agree on what to do when things didn't lease up as fast. And those were cases when it ultimately made sense for us to take back the asset and do the leasing because they were just not getting out of each other's way. They were more concerned with fighting with each other than supporting the asset. So, we learned that lesson, and now we ask the question, who's in the sponsorship, who controls? GPLP is good. 3 equal partners, not so good.
No, I agree. I mean, look, we had our share of mods and forbearances through COVID, especially for our hotel portfolio. But I think, we did see again that sponsorship is of paramount importance, and thankfully, almost all of our borrowers stuck with their deals and put in fresh capital, and we were willing to approve short-term mods and forbearances to get them through it.
So well, first of all, stepping back, we filled out a DDQ for an LP recently, and they said, so how many loans have foreclosed on, and what's your delinquency rate, and so forth. And I asked, if the number is higher or lower, is that good or bad? Because let's say you have no REO. That's not necessarily good. That might mean you're just more leniently rolling things over. The old expression, a rolling loan, there's no losses, right? So at the end of the day, we do have a handful of REO. I would say in all cases, it sounds, Andrea, familiar, the sponsors just chose to focus elsewhere in their portfolio, and in a very commercial adult way, we took title to a handful of assets, and we're actually going to do okay. It was not necessarily an issue with the underwriting or a value really being upside down as much as the where the sponsor chose to to focus, including some very big sponsors. So, interesting.
So let's switch to markets for a second. So obviously, if you're putting out billions and billions of dollars, you're in the major markets. But as you think about some of the better secondary markets like maybe Nashville and Austin, I'm sure you're starting to play in those. But are you venturing into those, and how do you think about those? And then are you pushing into even further into tertiary markets?
Some of it is a function of the sector, right? So would you say middle PA, Pennsylvania, is a market to focus on? Would you say San Diego for office is a market to focus on? Anybody know where Ashburn, Virginia is? Okay, it happens to be like the world's capital for fiber. So if you want a data center, that's actually the Fifth Avenue of data centers. So, and San Diego happens to be the third largest life science market. So guess what? And middle PA, you can get to 2/3 of the country, and Canada if you're in the distribution business. So we go where it makes sense, and sometimes it's not in a city or a place you would think of as major, but it's not tertiary for what's going on with what we're doing.
Yes.
I would also say that we do like a lot of the markets that you mentioned, Nashville, Austin. Those are markets that we've been active in pre-COVID and post-COVID. Really good overall fundamentals and good population growth, job growth, and all those things. So I think those are markets that we probably have been a lot more focused on over the past 4 or 5 years than we were traditionally. And the asset, as sort of like the investable universe within those markets grows, there's just more assets to choose from. And part of it was a challenge of like the scale of looking for large investments, as you mentioned before. The insurance capital, which is in certain ways focused on some sort of smaller and medium-sized investments, gives us the ability to invest in more of those markets. So we've made loans in Salt Lake City and places like that I think we really like the fundamentals in, but usually it's hard for us to find scale, but through that capital, it's been a good way to participate in those markets.
So that's going to be your challenge now with the insurance money.
I was going to say, I think to Tim's point, as you bring in the insurance capital, when you're doing a mezz fund, right, you need a loan that's large enough where you can originate a whole loan, sell the senior, and own the junior. So the loan kind of needs to be like $100 million or more, which leaves you with the gateway cities. As we all get into investing insurance capital, I mean, you've been in it for a really long time, that really benefits from smaller loans. So you're much more open to other markets where you might have liked a deal before, but it's a lot of work to come out with a $5 million piece, so you didn't do it. So we will now be looking at more of those markets.
Yeah, I agree with that. I mean, it's somewhat dictated by size, given that the larger loans are in the gateway cities. But once again, with the insurance capital, as we do more fixed rate lending, and our sizes range from 40, 50 million to $1 billion, you're doing smaller fixed rate loans, 40, 50 million, and we have done this year, a lot of multi-loans in markets like Nashville and Austin that we like a lot.
So has the size of loan changed as your portfolio increased?
Actually, our size of loan, I was looking at this the other day, the overall size of loan of the $16 billion or so that we've done this year is pretty close to what it's been historically, but it's been a little more barbelled in that we're doing more loans that are in that $50, $60 million range, and we're doing more loans that are $600, $700, $800 million. But the average ends up being about the same as it was before. It's just kind of more spread out, dispersed than it was.
Yeah, I think if you asked me a month ago, I would have said to you, we've done a lot more smaller loans. Because coming into this year, there were a lot of multis and a lot of industrials, and they were, 50 to 70, and you didn't have the large office deals, so you're going to do the smaller deals. There's no opportunity cost. And then we just did one that was, 600 million, so now my average is the same. But the composition's very different.
Yeah. Yeah, our average loan size is just north of 100 million. It's been that way for the past few years, but, depending on the deal, like I said, we'll if it's a multifamily deal that's simple to underwrite, we'll go as low as 40 million. And if it's a construction deal that's more brain damage, more complicated, it will have to be larger.
I have the same answer.
So do you find that you're increasingly teaming up with other people in your space to do deals, or are you doing more and more deals on your own these days?
I would say for us, I think we continue to do a lot. I think the market demands that we do a lot of single source originations. I think that's one of the ways we all compete in the market. But what has been interesting is each of us has developed more capital in more areas. We can all work together more maybe than we were able to before, where Sang can be in the senior and we can be in the junior, or vice versa in the next deal. And so I think which I think is a healthy thing for the market overall. There's more participants and more pieces of the capital structure. And I think what we all bring to the table to a lot of borrowers out there is that ability to think like an equity investor. And so when you can put a deal together with folks that can take that view and do the senior, the middle mezz, and the junior mezz, I think that's a really good thing for the market.
As Andrea said, a $500 million loan is really a $100 million investment to us. So they just don't get big enough to require distributing, and it's a huge advantage. Borrowers want one party to deal with. So
I think what we're distributing, for the most part, is the senior debt.
Right.
So we'll speak for the whole loan, and then we'll find one or many banks to take the senior piece ahead of us. The only difference may be if there's a loan where Brookfield is the borrower, we now, through our insurance capital, can take a piece of the debt as long as we're less than 49%. So now we will actually go pari passu with somebody on something like that, which was not something we did prior to having that capital.
And something that might be interesting to a lot of the students in the audience, how have your lending teams been either growing, expanding, or not growing, or contracting?
We're growing, so we need more people. We need
FASTOV, FAS at squaremile.com.
Yeah, and we need smart young people. So that's what keeps the whole thing working.
Yeah, we've expanded the team in all our offices this year, London, New York, and LA. Going forward, there may be some additional hires, but probably more on the junior side. But the team has grown.
It's the same thing.
Yeah.
We're growing. Unfortunately, we don't tend to be, hiring that many people right out of school. We tend to look for people with at least 2 years of experience. But from that level, kind of all the way up to SVP, we're growing. And then as far as, more senior MPs, MDs, we tend to kind of grow that internally from our, VP, SVP class.
You guys are always growing.
Yes, growing.
How would you say your investor base has changed?
I think the biggest change for us has been the insurance capital, which is a growing piece of the capital that we have to deploy. Outside of that, within our traditional funds, I think the investor bases, by and large, are relatively similar to what they were pre-COVID. A mix of domestic pension funds and endowments and folks like that, and foreign investors as well.
Yeah, I think on our fundraise, so we just finishing closing on a $4 billion fund. And so because that was really like in the middle of COVID, we saw a little bit of change. We always had a lot of Canadian investors, and it took Canada a little bit longer to get out of the COVID. So we had less Canadian investors coming in initially, and we had way more Asian investors. And I think it's simply a function of us fundraising during COVID, and the places in the world that were through the COVID crisis were the ones who were giving us more capital, and the places in the world that were really worried about office buildings and will anyone ever come back, they were later to the party. So they're now coming to us now and saying we're interested, and we're saying, stupid me, I agreed to a hard cap of $4 billion, and there's no room. Because when I didn't think we were going to be there. So that was my mistake.
Yeah, we invest mostly out of our insurance capital and our mortgage REITs, so it's more permanent capital. So, from an investor standpoint, that hasn't really changed that much.
So our focus has been more institutional, domestic pension funds, a little insurance company, Middle East sovereign wealth, Asian money as well. The big thing I think for us is more and more from Europe. Maybe it's mostly because we weren't there as much as the rest of the crowd here. And what's really interesting is they're having a huge impact. They're into ESG over there. And we're going to start to feel what that means more and more and more. So some investors will not give you a commitment if you don't respond right on the ESG front.
So given where the world is today, are you finding easier or harder to put the money out?
Is it fair to say it's always hard? So in the middle of COVID, This was a construction loan that had been going on for a long time. It was an industrial project. Post-COVID, a very large company that everybody's familiar with takes the entire last mile distribution center. And so we go from a spec building to a built-to-suit to the biggest player in the space at a lower value in terms of value or advance rate or basis. And it felt really hard at the time. And now we're making loans and we're busier, but they both seemed hard. So I would say it's hard at all times, no matter what anybody says.
Actually, I want to add to something that Jeff said, which is interesting. We're all seeing there is a huge momentum shift in the amount of focus our investors are placing on ESG. And when they say ESG, it's really climate change. I mean, that's really been their number one focus. And so you have to, when you're talking to investors, you have to walk them through how you as a debt provider are going to influence the climate decisions of your borrowers. And that's, just a wholesale shift. And those of us who grew up in, commercial banks with lender liability kind of, twitch a little bit. But, we're having to really make sure that we're making it clear to our investors that climate change and, ESG is really important. And we have specific parameters now and that we need to go through every time, we make a loan to make sure that the buildings we're financing are actually positive on the ESG front. So that's the biggest change, I think, since we talked last year. It was not, last year was all COVID. This year it's all ESG.
You guys have been at the forefront of this. Do you see that?
Yeah, I think it's a huge focus. And I also think that not to let ourselves off the hook, but the market also is commercially sort of figuring this out itself. We talked about it at the beginning with the demand for space, and I think the tenants are driving it, which means that borrowers are going to be seeking more opportunities within high quality office space, for example, new office space that's more has less of an environmental footprint, and that's going to lead to more opportunities for us all to lend into those styles of things. So I think the good thing is the market as like a ecosystem is kind of moving in the right direction, and it's being driven really by capital markets and investor demand at the end of the day, the folks that Jeff was referring to before.
So looking forward to the next 12 months, you've all got lots of capital to put out. You've got all these new restrictions. You've got investors that are thinking about all this stuff. How do you think you'll do more business? Do you think it's going to be about the same? It's going to be tough?
I would say that I'm hopeful that transaction activity, I think Andrea mentioned it before, like there's still some asset classes that are kind of hanging out in the dark that haven't made it out yet. I don't know, I think New York City office occupancy, physical occupancy is still very low. I think I read it's in like the 30 or 40% range or something like that. So in terms of, I think transaction activity, could pick up next year as just more of COVID is behind us and there's more activity, there's more leasing momentum in certain asset classes. So I think transaction activity will be a big positive for the space overall, and that usually drives what we're all able to accomplish. So if that transaction activity is up like you would suspect it will be, then I think we'll all be a lot busier next year. As long as we can find lawyers and others to help do the transaction. I mean, a little supply chain logistics issue going on right now, but.
Well, that's an interesting point. Do you guys feel that as well? You're having shortage of lawyers and consultants and accountants to work on deals?
We were talking in the green room, the hallway over there, about, for the first time, I think, in my life, we've said to people, if you want to close in the first quarter, we're there for you. Otherwise, we can't help you.
I agree. I mean, right now, we still have a few billion of loans to close for year end, and anything that's coming in now is definitely for 22.
We're still trying to close more loans this year, but we just may be a little bit naive to how much of a challenge it's going to be on manpower. But we've got a few law firms that do a lot of business for us, and so they will find somebody to work on our deals. But we do a lot of it in-house too, which helps.
Have you found, like we have in some of your construction loans, that your borrowers are just having trouble getting their materials in, so they're making changes in the loans because they're making alternative choices on their materials, and it's just you're reworking it? I don't know. We're finding that.
Definitely, and their costs are going up, right? You're seeing that.
Yep, sure.
All right, let's talk about the most creative deal you did in the last 12 months.
Well, no doubt it was the deal I did with you. May have been 13 months ago. I would say, instead of a deal, can I just answer a different question?
Sure.
Okay, yeah, so
You want to moderate?
I'm a lender, right? So I'm not supposed to do anything interesting. I'm supposed to get the money back. So, but what is interesting is just the types of real estate we're doing. So I mentioned data centers. We're doing that. That's new for me anyway. And by the way, it's not like we're making it up. We have a huge equity business that knows what they're doing, just so you know. Student housing. In the middle of COVID, nobody's going to college. We love student housing construction. First of all, because it won't be delivered during COVID, hopefully. But not only that, I think it's all about people want a good value proposition. So if you go to a state flagship school, the experience and the amenities and all of that and what it costs are truly a good value. And they need purpose-built student housing. People want the technology and the layouts and their own bathroom and all of that stuff. So we think that's a great thing. Life science, we've already talked about. That's there. And then last mile, multi-story industrial and dense places is very new and different. And we're making big commitments in that, both debt and equity. So to a lender, these are all very interesting things.
Okay, creative answer, but you didn't answer the question.
Yeah, we did a pretty interesting office to life science conversion deal in the city on the far west side. We were fairly low leverage, 50% loan to cost, but we had a good mezz behind us, very strong sponsorship, defensive basis. We got paid I wouldn't say a good return, but a fair return. And we've been pretty selective, seeing a lot of deals on the life science front, and we've been pretty selective, so this was a good one. Yeah. US Bank Tower was a close second.
All right, so I guess something different. We teamed up with one of the banks to finance the acquisition of a publicly traded company by another publicly traded company. So this was something that kind of came to us with a very short fuse. This company wanted to buy the other company, and I'm not sure what's public and what's not, which is why I'm using weird words like this company and that company. But they came to us and said, the bank wants to commit. They can't take down the junior piece because they can't hold it over year end. Will you team up with them? Fortunately, our equity team had taken a look at the company, and so we had a value. Like, we know what they thought all the real estate. So literally in less than 3 weeks, we were able to commit to take the $600 million junior tranche on this financing, and fortunately our guy won the bid, so we'll be able to fund that in February. So that was kind of exciting.
Right. Tim, in the $20 billion that you're going to close this year, there's got to be one deal you want to tell everyone about.
I like Jeff's answer. Non-answer. But I would say, no debt deals are all that exciting necessarily on a standalone, but we did lean into a couple of markets and asset classes that I think things were a little unsure, and maybe in some cases still are a little unsure, but we feel like we have high conviction in. So we did a big office redevelopment here in New York City on the far west side, Terminal Warehouse, where there's vacant building, and New York City, I think there's plenty of concern around return to office and tenant demand over time, but we feel like the best assets will continue to do really well, even in markets where potentially lower quality assets struggle. And I think the one where we leaned up maybe the most was we did a spec office deal in San Francisco, a new acquisition financing, tenant vacating, and it's going to be an entire redo of an office building there. And that market, probably has maybe the worst press around the country in terms of the office market, in terms of people back in the office, but fundamentally, very limited supply in that market, pretty limited Class A stock overall in the city. And again, we feel like long-term fundamentals, the best assets are going to win, and people will ultimately come back to the office, even though potentially there's maybe less demand in total than there used to be. We still think there'll be plenty of demand for the best quality assets. And so a couple of examples where we stepped out a little bit, and those are both big deals. They're both close to $1 billion financings.
Jeff, you mentioned that you use leverage sometimes to juice your returns or do a loan on loan. And I'm just curious how each of you view, sort of past history to today and going forward, how that might change.
Yeah. Well, I think one lesson from COVID is the liability management or liquidity management can be as important as the risks you take at the investment level. So we've focused on facilities for the most part. We've made sure that they're as stable as and match term as they possibly can be, as well as individual one-off mortgage sales. I think the mix is not really going to change. For a lot of higher quality deals, the counterparty doesn't want to deal with anybody but the lender they chose. So if you're going to tell them you're financing with another party that will surface in their life, they'll go somewhere else. So sometimes the way you finance yourself is also the way to get the better deals.
Yeah, we have seen that for our borrowers. We don't use warehouse financing and we don't use repo financing. So we typically have taken down loans and sold the senior, but we have seen some of our competitors very effectively sell against us on that point. So we have started taking down whole loans, and then we'll just do a loan-on-loan financing in order when a borrower says, you got to take down the whole loan or I'm going to, I don't know, somebody else. So yeah, we will do, that's a change, not necessarily due to COVID, but just more due to market competition.
Yeah, I mean, I think nobody wants to manage a repo portfolio in the middle of COVID, so that's not a fun thing for anybody. But it held up well for people who had structured it all the right way and have good relationships with the banks, and it's a useful tool in a toolkit overall. So I think we obviously want to be careful on how much exposure we have to it at any one time, but when you put it together with A-note financings and CLO executions and things that are different, off-balance sheet type transactions, I think, it's still a useful piece of the puzzle for us.
So as the traditional banks have seen how successful you all have been at this, do you think they're going to start to get into the business, or have they already started to get to this? We see, what Jeremy Hellinger has done at JP Morgan and others. Do you see them more and more aggressively in the market?
Well, a lot of what they do or don't do is driven by just return on risk-based capital. So long as there's regulatory pressure to focus on senior, lower risk positions, I think there will be space for non-bank lenders. I think a lot of what you see the investment banks do is a pretty small part of a very big pie. So I think there's room for us on an enduring basis.
Also don't see them with the size holds that we have, and they typically may bid on deals and take them down, but they usually need to bring in other lenders, pari passu or senior, junior to make it work for them.
Yeah, it feels like the banks have been pretty happy with the dynamic almost. I mean, I think there's sort of less stress when you're managing loans when this group of people is in the junior position, and I think that's helpful. We do a lot of the heavy lifting on the front end. We have probably more and more of the teams are sitting at our organization. So I think between that and really it's all driven, as Jeff said, by capital treatment, and I think that's actually a pretty good equation for the banks.
Any other competitors coming into the market?
I actually think that the competition is really centering around some of the larger players in the market. It used to be I could name 10 people that we competed with on a lot of deals, and I think there are fewer really good, effective competitors. I think the larger organizations have really taken a large part of the market share, which is actually good for the market because it keeps discipline. I mean, we may all have slight nuances around what we like better than each other, but we're all basically very disciplined lenders. Mm-hmm. And, sometimes if you have a small shop, which is, living on their management fees and just has to get money out, they're not going to have, quite as much discipline.
So that means if someone like me wins a deal, I'm either doing something crazy.
Or you've got a better relationship than we do.
All right, so we got 2.5 minutes left. What do you want to talk about?
What was your favorite deal that you did that your debt team did this year?
We did a $100 million deal in Austin to a hotel condo deal. That was really cool. We just went to visit it. We had used Formula One as our decision why we went down there, but we checked it out. Really cool deal. And then we made a $700 million construction loan to a mixed-use project in Bellevue, Washington, which actually my team's out there now for the closing dinner. We closed at the beginning of this year. So those are the two cool deals that we did that I really liked. But I'm not as involved in it, but I get to approve them.
Inflation rates?
Inflation rates.
Inflation, anyone?
Transitory.
Floating rate loans?
Where do you think the 10-year is going to be this time next year?
Oh, that one I have no idea. I would do something else for a living if I had any idea.
Exactly.
No, but I mean, I think there'll be, much like what we just saw with what we were talking about before with COVID, where it's going to be a differentiator in terms of asset classes. I think in an inflationary environment, you're going to see the same thing. It's just going to put probably some positive pressure on certain asset classes that are poised to grow and keep up with inflation, or at least keep, owning hard assets that have growth potential is a good thing in an inflationary environment, and it's going to put pressure on things that don't have as much growth potential, be our guess.
Well, look, this is the 5th year I've had the privilege to run this little panel, and I really appreciate you all participating. It's been great. Thank you all very much.